4 and 3 and 2 and 1. What up? And when I'm on the mic, the suckers run. Word. And my daughter asked me, Daddy, what's a sucker? And I said, I was a sucker. I was a sucker back in the day because I didn't understand how my credit worked. I didn't understand credit because it was never taught to me. There was no class in this. 19 years of formal education, no one ever taught me the rules to this game. So if we're talking about credit, let's define some terms. An inquiry. An inquiry is where a lender or a potential lender is going to look at your credit report. Revolving credit is like a credit card. Installment credit could be a car loan or a mortgage. And credit history is your history. It's your performance summed up in a number, your credit score. So here are the buckets for credit score. I spent plenty of time after college in the stinky barrel. But if you look, you can see that it doesn't take much to get from poor to average. I mean, that could be 80 to 100 points. You can see the uptick in the U.S. population down there at the end. That this recession has caused many people to end up with a lower credit score. So that's what this is about, is improving your credit score, understanding your credit. So what does good credit get you? It gets you street cred. It gets you solid gold hits. It gets you awesome interest rates. I mean, that's what good credit gets you. So conversely, what does bad credit get you? Well, bad credit gets you high interest rates. Bad credit can result in high insurance premiums. It could eliminate job opportunities for you. You may not get in the door for a job interview because your credit score is too low. And what else can go wrong? Well, your credit history could be so bad that it starts circling the drain. It gets lower and lower, and suddenly you can't get a loan. No one's going to give you a loan. No one gives you insurance. Nothing is going your way. And it's all based on your score. So what's in a score? How is it calculated? The three major credit reporting agencies use the same basic framework for calculating your credit score. 5 categories. The first category is history, and your history is you. It's your performance on your loans over the last so many years. They want to know, they know. They're tracking and calculating based on were you on time with your loans, and how often were you on time, how often were you not on time, and how long or severe was your delinquency on a particular loan. The next thing they look at is your capacity. Of the, say, revolving credit or credit card cards you have available to you, how much are you using? Are you using all of it? That's bad. Using some of it? That's good, because it shows you're mature with your credit. So if you use too much, your credit score is going to go down. Size doesn't matter when it comes to credit, but length does. Length is very important. How long you've had your loan open. If you've had a loan open or a credit card open for years, keep it open. Even if you pay it off, keep it open, because that improves your score. They want to know if you're accumulating your debt. Did you get a Banana card and a Macy's card and a Sears card all in a month? Well, your risk profile just shot up, because it's a potential for you to get into some serious trouble with your new credit. So that can affect your score. And then they want to see diversity. They want to see a mix of trade lines to show that you're mature with different types of debt, with revolving credit, structured credit like a home loan. So what can you do? What can you do to improve your credit score? Well, make your payments on time. That's always a good start. Increase your line so you hit that diversity benchmark, and make sure you use your credit cards. Don't have a card that you don't use, because they know what you're doing, that you're just camping on it, so use it every month. Now, if you find you're behind or you find your credit score is low, make a plan to get out of that. Make a plan on how you're going to improve your credit, how you're going to bring your loans current, how you're going to approach the next lender to ask them for a better rate, and in support of that plan, make a budget. It sounds simple, but it is the key to improving your credit score. It shows the money you have coming in every month, and it shows where the money goes to ensure that you're planning to make your payment, because if you can't make your payment, if you're running into trouble, take your budget and your plan and go visit your lenders if they're in town, and ask them for a break. You show them the maturity of your budget and your plan, and they'll be more than willing to work with you, because they don't want your car. They don't want your house. Next thing you can do is police your own credit. Order your credit report online every year. Make sure that there are no mistakes in it. Go ask your own financial institution for a copy of your credit report. I'm sure they'll give it to you. And resolve and dispute anything that's wrong. And finally, be patient. Because your credit score isn't going to change overnight, but with a couple of months of care and concern, your credit score will improve and you will get that lower cost loan and not be a sucker.